But we are pre-recorded today, ladies and gentlemen, and we wanted to look at the news. And when we look at the news, we don't usually look too far. Zero Hedge holds a lot of the information that we're interested in. And today we're going to be looking at how to tell the difference of when a bear market is ending, just starting, or if we found ourselves in the middle of it. And the little bit of information I've found on Zero Hedge today is actually extremely valuable. So I'm going to, unlike I normally do, pretty much just read what I'm reading from Zero Hedge. There's a lot of very valuable information in this article, and I will leave this article link down below, quoting from obviously the Tyler Durden here, the famous Tyler Durden. The remarkable rebound in the U.S. stock market follows from the lows of late December has resulted in gains that the analysts at Goldman Sachs rightly point out already constitute banner for the returns of the entire year. This means that they believe that the bull market is over. Although history is replete with examples of major recoveries following big sell-offs, many of which turn out to be head fakes, otherwise known as bear market rallies. At the end of the trading day, it's still fundamentals that should drive your investing decisions. And if the economy is in fact slowing down, it is what has sidelined the Federal Reserve. And then what we are witnessing at this moment is also the bear market rally. AdMacro Ltd, head of the research Patrick Perret-Green, warned recently the firm's clients, though, that January employment jobs report might have looked good on paper. With over 304,000 jobs created that month, it nevertheless flashed a bright recession signal as the unemployment rate ticked up to 4% since its highest in June. Now, one of the things that we had mentioned over the last few months that we were looking for in this bear market sentiment was essentially the S&P 500 again recording another lower low, or at least a lower high in comparison with Q1 or the first quarter of 2019. The research company here is also stating that looking at the jobs report numbers is another tick and flashing light in that bear market recession coming down the way. I do believe that this holds negatively for all of the markets as sentiments globally affect each other. As we see in the Bitcoin space, when Bitcoin moves, all of the altcoin digital assets move with it. Now, there's always been a lot of controversy of whether Bitcoin would go up and or down during a stock market rally or a decline. I've always sat towards the side that Bitcoin has nothing to do with the stock market. It is a replacement for the dollar system. So any troubles we see in the stock market might see a little bit of bleed over, but inevitably Bitcoin's value and its true understanding of value comes in when we start to realize what is wrong with the fiat money system, not the stock market. Although I will be very grateful and interested to see what blockchain can do for the rest, or at least the distributed ledger consensus can do for the rest of the stock market and global markets as a whole, because I believe it will cut costs, therefore increasing profits and giving more playroom and less overhead to those who wish to use the technology. So back to the article here. Again, it says, according to the historic payroll data, the National Bureau of Economic Research says every time there is a 3-month average of unemployment rate that exceeds its 6-month average and cycle peaks over the past 50 years, like it did in January, the U.S. economy has experienced a recession. In 2016, the speech of the International Monetary Fund, then Federal Reserve Bank of New York president and current Bloomberg opinion contributor, William Dudley, ladies and gentlemen, corroborated this historic pattern, citing research first conducted earlier in his career at Goldman Sachs. We quote him here saying, "History shows it is very, very difficult to push the unemployment rate back up just a little bit in order to contain inflation pressures. Looking in the post-war period, whenever the unemployment rate has increased by more than 0.3 to 0.4 percentage points, the economy has always ended up in a full-blown recession. With the unemployment rate raising by at least 1.9 percent points this year, this is the outcome that we want to avoid, especially given that the economic downturn at the last is to be hired is often the first to be fired as well." To Dudley's point, the odds of layoffs continue to rise or high as January's data from Challenger, Gray, and Christmas layoffs have risen to the prior year for 6 months straight. Economists would characterize this as the established trend. Retail and more recently energy have been on some of the weakest sectors, and media is another sore spot. Backing out to the broader economy, one of the fastest growing reasons for increased layoffs last year was the mergers and acquisitions. Again, this likely led to be no let-up in 2019 and the year's record M&A activity, which is just one of the more creative avenues companies have pursued to reduce costs in recent years. The looming earnings recessions will compel firms to be more direct in their approach, as well as an outright headcount reduction to protect profit margins. Auto dealers are also struggling to shoulder the weight of the most crowded lots in almost 2 years as a result in auto production, which had started to contract in January, promising the pressures of the Midwest manufacturing a standout area of the economy in recent months as other regions started to falter. As this were the case in the earnings, the sudden stop in motor vehicle parts also swung from 0.84% this year-on-year growth to December 0.7% contraction, according to the industrial production data from the Fed. And although autos were the sweet spot and the delayed December retail sales, the strength appears to be wavering as cumulative tax refunds start to disappoint. In the first 18 days of tax season through February 21st, cumulative refunds totaled $36.36 billion, down $61 billion or 63% from the same period last year. This portends poorly for the seasonal surge into auto buying and consumer spending tied to household properties prosperity and to spend the majority of their tax refund proceeds. If anything, the Fed data shows that households are hunkering down, with checking and savings accounts balances rising dramatically, moving generally associated funds with spending pullbacks. It is also the combinations of an earning recession and an economic slowdown that derails the parallels of 2015 and 16 stock swoon and then rebound. As a breathtaking rally off the Christmas Eve lows, it is not all that unusual to see the protracted and magnificent surges that punctuate the bear markets in the 5 months through August 1989, and the S&P 500 rally then 20% before sliding back down. Again, what makes the current run historically remarkable is the magnitude of the 10.5% rally in such a short time span, which bellies the bottoming of the unemployment rate and the face of accelerating layoffs. Again, it was a bit curious to read in his recent Bloomberg opinion commentary that Dudley thought it was hard to see how the normalization of the Fed balance sheet and tightening financial conditions in a way would have weighed significantly on stock prices. The current bear market rally was, after all, catalyzed by Chairman Jerome Powell's assurance that the quantitative tightening might be suspended soon, in a stance since corroborated by both the hawkish and dovish Fed officials. Skeptical investors have been badly bruised and were emboldened by this fight for the Fed to see. This may be a bear market rally for the ages, but that shouldn't imply that investors do anything other than rent it. Owning it promises to end in tears. And we agree very, very firmly in this sentiment. If we roll over to the S&P 500, we have hit that top of the peak, something we had seen just back in November of 2018, as well as June, March, and March again. This is a very strong area of support and resistance. Ladies and gentlemen, I am keeping a close eye on the stock market. Again, what they said here about the Fed going hawkish or dovish, this is where I believe we will find more information about what is going to happen to Bitcoin's price movement. A negative turn in the stock market does not necessarily mean something positive for Bitcoin, although a negative trend in the dollar does. This is Teal with the Arcane Bear. I won't be doing a little update hopefully later this evening. A bunch of you had asked me to go over Monero, Neo, and a few others, so I will take those tokens onto the account tonight, and I'll take a look for you. I'll let you know what my thoughts are, although currently the bear market rally that we just saw, I believe, is nothing but a fake out. We will continue to decline in price and likely in the stock markets as well once we start to find more of an average bottom, probably somewhere in the middle of this next year. We will see one of the most incredible price movements in Bitcoin that we can possibly imagine, but I believe that will be very, very, very closely tied to the movement of the US dollar. Smash those thumbs up 2019 style if you guys enjoyed this content. If you're new to the Bear family, hit subscribe and that little bell. That way anytime we produce a video, you guys will be notified. I am driving off to San Jose to pick up some friends before driving back down to the festival here in Costa Rica. For any of you that might happen to be in the area, I hope to see you dancing barefoot in the jungle. Still with the Arcane Bear, I am signing off for the rest of the day, and we will see you guys in the next video.